Let's get a quick perspective on what global market speakers are making of the global situation. Paul Schulte, who's CEO and Chairman, Schulte Research, joins us from Hong Kong. Paul, the key question is how would you explain the strong rebound that the U.S. market staged in Friday's session, given global volatility all of last week and also geopolitical tensions that have been impacting sentiment? Does it seem like that the U.S. that a lot of people believe there's still value in U.S. stocks?
Yeah, I think that's right. First of all, we have, the 10-year bond was coming down to almost 230, so we had a lot of support from the bond market. You had a stronger dollar. You had very good earnings that were coming out. The earnings were good to very good coming out in the last week or so. So you have an earnings picture that's good, an interest rate picture that's good, a currency picture that's good, a flight to quality issue for the U.S. away from a lot of these other riskier areas of the world. And so altogether it paints a pretty good picture for that. And we have a very benign Fed. So those are 5 reasons why the equity market continues to move.
All the 5 reasons which you outlined, they clearly indicate that developed markets are in a better position than emerging markets. Up until now, at least so far for this calendar year, emerging markets have done marginally better than developed markets. Do you think the trade could reverse, come winter?
I think the outperformance of the emerging markets has been, sort of marginal. I think that what I think we're likely to see toward the end of the year, I think, is actually a move away from some of the more expensive developed markets, like the U.S., for instance, toward the end of the year, into ultra cheap markets like China, for instance, as one example, where China is trading at somewhere like a 60 to 75% discount to the U.S. equity market. And so I think there is going to be some switching there. I think that's already occurring a little bit, but I think that may be more out of Europe and the U.K. than the U.S. I think Europe and the U.K. is a much bigger problem than the U.S. I've been saying that all year long. Europe is a very big problem that people underestimate.
Do you think it's a big enough problem to impact the optimism and the rally that we're seeing in the U.S. right now?
I think that's potentially a problem. That's right. I think that we still look at Deutsche Bank. Deutsche Bank is the anchor of the euro, and Deutsche Bank keeps on hitting new lows every single day. I think part of this is the way in which banks like Deutsche Bank, Credit Suisse, UBS, and Barclays, who are the largest banks in New York in terms of the high-frequency trading, are all under investigation. And so I think that's putting a damper on their stock prices. So we have a very big negative sentiment on all 4 of the largest, European banks right now because of potential criminal and civil litigation due to the high-frequency trading in New York.
Paul, if I just monitor the flows which have come to India, even though the world is in a mess and Indian economy is all set to make a comeback, the institutional appetite is okay. It is not extraordinary. Given the kind of cues, a market like India is working with, one would have imagined that India should get bulk of the emerging market flows.
Well, yeah, but hold on a second, though, because India, I'll give you the example. The banks, for instance, in India, these are among the most expensive banks in the world. So there's an awful lot of good stuff, baked in the Indian cake here. I think a lot of people missed out on the rally early on in the year. I think they jumped in, prior to the Modi election, and so India has been a very good performer over the last 12 months. But at this point, it's a very expensive market. Also, Barron's did a very long article last week, sort of saying, India's, cooked and, get out because it's a very expensive market. And so the article in Barron's might have had a little bit of a sentiment damper.
Mm. So how do you position yourself on the region at this point, especially in terms of allocations? What are the trends that you pick? Do you think that in this second half we're going to be looking at incremental money getting directed to India and China, perhaps?
Well, as I was on your show last time I was here, I talked about Thailand, Indonesia, Philippines. The credit cycle is still very much in their favor. Those banks keep on hitting highs for the year. So those continue to be my favorites. I talked about I was very bullish on Japan last time I was here. We had a bit of a setback on Friday, but I still think the Japan trade is on. And I just think right now that the China trade is interesting because it's such a laggard market. These are some of the cheapest companies in the world, and I did a very exhaustive credit check of the entire corporate sector for China. And while there is a significant pocket of problematic companies, mostly in the utility sector, by the way, and also to a lesser extent property, the Chinese corporate credit market is actually in pretty good shape. So this is one of the cheapest equity markets in the world, and I think people are going to start to push money into the area of China.
Well, what's extraordinary right, Paul, what's extraordinary is the US 10-year paper. I mean, who would have thought at the beginning of the year that the US 10-year would go way below 2.5, and as we speak, it is sitting at what, 10.35, 2.35?
Yes, sir. I know. It's remarkable. I think there is, I've been noting this. I think the U.S. banking system is one of the healthiest, most liquid systems in the world, but we still have a very, very sick and anemic banking system in the UK. We have a very over-leveraged banking system in Europe, which has not done enough to deleverage and reduce the asset sizes. And we still have Deutsche Bank coming on to new lows. Really important to watch Deutsche Bank's stock price. This is one of the biggest banks in the world and the anchor of Europe. Stock price is telling us terrible information. So we still have a lot of anemic weakness, structural weakness in the banking system of Europe, which is 20% of global GDP. And I think that's what's spooking the world, on top of these other, I think, associated issues like Iraq and the Ukraine.